some academic research claim that we don't need risk premium to understand the profitability of carry trade strategy. These guys wrote a paper using market frictions to understand the profitability without using risk premium at all. In fact, they assume investors are risk neutral in their paper, and they show that even in that case, we can generate profitability of carry trade strategy. Let's talk about this one in the next slide. By the way, I post this paper on Blackboard. Again, if you understand everything in my slide, you may have to read this paper. Bruno Meyer et al. Assume that investors are risk neutral. I'm gonna use US-UK example to explain the main essence of this paper. Investors are risk neutral, so they do not ask any compensations for taking risk. This assumption indicates that UIP should hold in an ideal frictionless setting without any transaction cost, any borrowing limit, any short selling limit, any limit on leverage. Then they introduce some short-run frictions in the market and show that UIP violations or profitable carry trade strategy can exist at least in the short run, but maybe not in the long run. So let's use an example. Let's suppose at time t, Bank of England suddenly increased its interest rate target, thereby attracting foreign capital inflow into UK. In a frictionless and risk-neutral economy, this should lead to an immediate appreciation of pound. Everyone is trying to get pound to invest into UK, associated with an inflow of capital. And since we are assuming investors are risk neutral and UIP should hold eventually, we should expect the future depreciation of pound from today's to the next period. So be careful, because of capital inflow, there will be appreciation of pound today, but UIP is not about today's exchange rate. It's about the changes from the today's exchange rate to the next period exchange rate. Let's talk about the profitability of dollar carry trade. Here we assume that UK increased its interest rate, so IT UK is higher than IT US for all maturity. This is so-called level effect. When the Bank of England increased the short-term interest rate, it will affect every maturity's interest rate. At time t, based on these informations, investors, speculators in FX market will conduct a dollar carry trade strategy, which means borrowing dollar and investing, converting and investing into pound money market, or buying pound forward. Two different ways of implementing dollar carry trade strategy. In real practice, when investors, speculators implement dollar carry trade strategy, in ideal case, you don't need any money today. You're gonna just make a promise today. After one period, you're gonna buy certain amount of high interest rate currency using forward contract. However, in real practice, speculators need to pay certain portion of their forward contract as initial margin. Well, they will get back this one in the maturity, so this is not actually the payment. They will get back this one for sure next time, but still they need to put up this one as an initial margin or collateral to prevent, for example, counterparty default risk. And let's say investor need to put 10% of £1 million as initial margin, and typically they will put up 5%, £50,000 from their own account and borrow 5% from brokers. When they borrow money from broker, they use some asset, not necessarily cash, as collateral for their borrowing from brokers or banks. Note 1. The alternative version of dollar carry trade, borrowing dollar, also involved with borrowing with some collateral. And note 2. It is well known that currency trades are conducted by highly leveraged professional investors. Anyway, in real practice, in order to implement carry trade strategy, you need certain capital today. It's not pure zero-cost strategy in that sense. In our example, investor put only 5% from their own account, but they will realize profit for 100% the whole pound forward contract amount. So this is leveraged investment. And this is the market frictions Brunnemeyer et al. Introduced in this paper. You may ask, why not leverage and invest more? In fact, the speculators in FX market, they're going to limit their positions because they have limited borrowing capacity, because they don't have enough collateral maybe, and also they know that this negative skewness of carry trade. In other words, small possibility of the extreme negative returns from the carry trade. Let's talk about this one in the next slide more precisely. We can think about weekly carry trade strategy and quarterly carry trade strategy. For example, for weekly, each time you're gonna rank different country based on 1 week interest rate, and you're gonna borrow from low interest rate currency and invest into high interest rate currency for 1 week. After 1 week, you're gonna realize the returns, and you're gonna rank different country based on weekly interest rate at that time. You just repeat that for a long time. You're gonna compute the mean, and this is the histogram based on that repetitive weekly carry trade strategy returns. We can do the same thing using 1 quarter interest rate. So you're gonna rank each country based on the 1 quarter interest rate, borrow low interest rate currency, invest into high interest rate currency. You just keep doing that every quarter and compute the returns. So this is the histogram based on that quarterly carry trade strategy. As you can see here, we have some skewness in the left-hand side. This is the meaning of negative skewness. By the way, what is the nature of this too? When do you get positive return or negative return from implementing carry trade strategy? You're gonna get positive returns when high interest rate currency appreciate and low interest rate currency depreciate. You're gonna get negative return when low interest rate currency appreciate and high interest rate currency depreciate. So just like the crisis time, when low interest rate currency appreciate, you're gonna get sudden crash from your carry trade strategy. And historically, it is well known that often we see that kind of crash from carry trade strategy. So we see negative skewness from the histogram computed using the historical data of carry trade returns. Because speculators are worried about this crash risk, they tend to limit their carry trade positions. So again, why not leverage and invest more? They may not have enough collateral for their borrowing. And number two, because of this negative skewness, small possibility of crash risk. So they claim that typically speculators do not fully conduct initially intended dollar carry trade at time t. And they're gonna slowly and gradually execute this strategy over the time. Thus, they execute part of the dollar carry trade strategy at time t and keep adding dollar carry trade strategy at t+1, t+2, borrowing dollar or buying pound forward contract. What is the impact of this one on pound at t+1, t+2? It is easier to see this with an alternative form of the dollar carry trade, which means borrowing dollar, converting and investing to pound. If investors keep doing that at each time there will be higher pound demand in the spot market. That means appreciation of pound at each time. So be careful. The dollar carry trade at t+1, t+2 is being executed because of the interest rate differential at time t, not the interest differential at t+1, t+2, because of the limit on their borrowing capacity. Because they worry about this crash risk, they're going to implement dollar carry trade little by little across different period. This means that high interest rate currency pound at time t will keep appreciating at t+1, t+2, t+3. So we can explain the UIP violation from t to t+1. High interest rate currency pound will appreciate from t to t+1 and t+1 to t+2. In sum, once investors, speculators observe higher interest rate in UK at time t, they will execute dollar carry trade strategy only gradually at t, t+1, t+2. Now this gradual execution of the dollar carry trade imply pound appreciation at t+1, t+2. Therefore, initiating the dollar carry trade strategy at t for t+1, t+2 will be profitable. High interest rate currency at time t will appreciate. That means profitability of carry trade strategy. So even without introducing any risk premium because of market frictions, leverage constraint, we can understand why implementing carry trade strategy can be profitable. However, recall that Bronnemeyer et al. Assume only short-run frictions. Thus, if you are smart speculators, once you observe this appreciation of pound, the violation of UIP, you should know that this one should be reversed. In other words, UIP should hold eventually. They need to go against dollar carry trade strategy, or we talk about reverse carry trade strategy before. What is the meaning of UIP should hold eventually? Recall that UIP state if UK interest rate is higher than US interest rate, pound should depreciate from T to T plus 1, but we observe that because of market frictions, pound keeps appreciating and appreciating. This is so-called bubble in FX market. At some point in the future, there should be massive depreciations of pound to reverse this cumulative appreciation of pound. Does this mean that some smart investors should bet on depreciating pound in some future day because they know UIP should hold eventually, so pound will collapse eventually? Yes, but this is not that easy in practice. Why? Why, even though they know that UIP should hold eventually, they are not go against carry trade strategy? If smart speculators bet on depreciating pound prematurely, they are exposed to short-term loss because they act against the market movement. Everyone else is betting on appreciating pound. Even though you a smart investor, pound will depreciate eventually. Even though that is the case, you will be overwhelmed by these other investor betting on appreciating pound. And because the speculator will have leverage constraint, they cannot dominate this market movement. For example, if this smart investor bet on depreciating pound at T plus 1 and T plus 2, because of this market movement betting on appreciating pound, in fact, the pound will appreciate at T plus 1, T plus 2, and this smart investor will lose because of this persistent dollar carry trade. When the pound keep appreciating over time, there are no reason to stop the dollar carry trade because investor by following market movement, they will keep getting profit from the dollar carry trade strategy. So holding on to dollar carry trade strategy is profitable for each individual speculator, including smart investor, until market as a whole stop dollar carry trade. When the bubble collapse. Thus, the pound is prevented from depreciating as described by UIP, leading to a build-up on exchange rate bubble. However, eventually, this bubble should burst. Massive depreciation of pound. Then we can ask this question, how does this bubble burst eventually? Let's assume some negative shocks occur to financial market. Typically, during this difficult time, we observe an increase of the global risk or global fear. We can proxy this one as higher VIX. What is the VIX? VIX stands for the Chicago Board Option Exchange Market Volatility Index. It's the implied volatility on S&P 500 in the next months. So higher VIX means investors think that in the future there will be more uncertainty in the stock market. These are often referred to as the fear index. Higher VIX means more fear about the future. Then these negative shock in the financial market will lower asset price in financial market. Remember, when the speculators borrow money and make an leveraged investment, they need to put some collateral. Normally, they will use some of the asset they have in their balance sheet as a collateral. So this negative shock will lower the value of this collateral, and this will erode the speculators' capital in their balance sheet. Then the lender to these speculators, they will ask more collateral, or if you don't give me more collateral, you have to pay back your borrowing. So bank will request to increase collateral, the margin call. By the way, the term balance sheet derives from an accounting identity that assets should be equal to the sum of the liability and equity. In an extreme case where asset price fall below the value of debt incurred to purchase them, the equity could be negative in financial institutions. in other words, speculators in FX market. What is the asset of these speculators? Mostly these financial assets. So in balance sheet, they have financial asset here, they have liability, they have equity. Because of this negative shock, the value of financial security, their investment, the value will be lower. If this gets much lower than even the value of debt, then they will get the negative equity. That means bankruptcy of these speculator or financial institutions. In fact, prior empirical evidence say that funding liquidity, in other words, how easy you can borrow external funding, dries up when VIX spike. So when VIX spike, you will get margin call from your lender. So funding liquidity will dry up. Typically, lending standard and margin will be tightened. So you have to pay more collateral during this difficult period. Thus, the leveraged speculators hit their funding constraint. They are getting margin call. They need to set up more collateral. They need to pay back their borrowing. It is more difficult for them to borrow new debt and to roll over current debt and to meet the margin call. As a result, leveraged speculators are forced to sell their asset in their balance sheet precisely when the asset prices are low. So they're gonna force to do fire sale of their asset. Moreover, at the same time, market liquidity will dry up. What is the market liquidity? It's about how easy asset can be converted into cash. How easy you can sell your asset. So when they try to meet their margin call by selling their asset, fire sale, even it's not easy to sell it, so that they need to sell their asset with even bigger loss. During the normal times, market liquidity is going to be offered from dealers in FX market. But market dealers in FX market, they are also leveraged with the funding constraint. So they're going to get the similar negative shock in their fundings. Not easy to provide market liquidity during this period. Thus, leveraged speculators in need of cash to meet the margin call find it hard to locate potential trading partners, buyers. Thus, they may be forced to sell their asset at a price below the long-term fundamental price. Again, fire sale. In summary, when speculators hit funding constraint, so they are forced to sell their asset to pay back their borrowing, fire sale, it will depress market price further. That means the value of collateral will be lower than before the fire sale. This is so-called liquidity spiral. Liquidity worsens. They are forced to sell assets that lower the value of collateral. That means another margin call. They are forced to sell another margin call. They are forced to sell. Just liquidity keeps getting lower and lower. That happens both to funding liquidity and market liquidity. So it's not easy to borrow and it's not easy to sell. So in summary, when VIX is high, liquidity spiral. So speculators will stop leveraged investment. They are not gonna implement carry trade strategy anymore. Now finally, pound will depreciating against dollar. So huge crash risk in carry trade strategy. Now smart investor will dominate the market. I want to make a note. We have well-known market indicator for crash. It's called risk reversal, computed with the option data. Risk reversal is a good indicator of the crash risk in carry trade. What is it? Risk reversal is the price of the out-of-the-money call minus price of a symmetric out-of-the-money put. What is the meaning of this one? First of all, symmetric means call put option strike prices are equidistant from current underlying spot exchange rate. I will provide an example in next slide to talk about this one more precisely. Let's first talk about what is the meaning of in the money and out of the money currency options. Let's assume the spot exchange rate is $2 per 1 pound. And we can think about put option and call options. What is the put options? Put options gives you the right to sell pound against dollar. So let's think about put option with the strike price $3 per pound. If you buy these put options, it means you can right away sell pound and get $3. If you do that, given this exchange rate, you can make $1 per each 1 pound. You can go to the spot FX market and pay $2 to get 1 pound. So you pay $2 and get 1 pound. And then now you exercise your put options to the seller of the put options. So you're gonna sell 1 pound to that guy and get $3 right away. So by exercising these put options, you can make the difference as your profit. So we call this put option as the in the money put options. By exercising this put option right away, you can make profit. And we can think about put option with strike price like this, $1 per 1 pound. So you have a right to sell 1 pound for this price. Obviously, given this exchange rate, you're not gonna exercise these put options. So this is so-called out of the money put options. By exercising these put options, you're gonna lose. You're not gonna execute this one. And we can think about the same in the money and out of the money options in terms of call options. What is the call option? It gives you right to buy pound at certain price. And we can think about call option with strike price $1 per pound. This means you're gonna buy 1 pound by paying $1. If you have that right to buy 1 pound for $1, you can exercise these options by pay $1 and get 1 pound directly. By exercising this call option right away, you can sell this pound in the spot market and getting $2. So difference is gonna be your profit by exercising this call option. So obviously this one is the in the money call options. By exercising this option, you can make profit. What about the call option with this strike price? There's no reason to buy 1 pound by paying $3 because you can buy 1 pound in spot market for less than $3. So this is so-called out of the money call options. Now, out of the money put option here and out of the money call option here are symmetric. The strike price, this one has equidistant from actual exchange rate, $1 difference. So we can compute risk reversal by using out of the money put options, this guy, and out of the money call option, this guy. By the way, why buy out of the put options with this strike price? If you exercise this one, you're gonna lose now. However, you want to prevent further the pound depreciation in the future. You are worried about pound depreciation, something like this in the future. If this one happens, and if you have put options, in these bad situations, by exercising these put options, you will be able to make some profit, the difference. And why buy out of the money call options? $3 per 1 pound. Here, you are worried about pound appreciations, like this one. So let's say this one happened in the future. Then, instead of buying 1 pound in the future spot market, you will exercise call options to get 1 pound by paying less dollar amount, $3. So by using out of the money put option and call options, we can think about the market expectations about the future. Let's think about the pound collapsing case against dollar. Let's say this happens. If you bought before this incident out of the money put options to sell pound exchange for dollar, you could make good profit from exercising this option. Let's say now in extreme case there's no value for pound. But if you have these put options, you can sell pound to get certain dollars. However, if you bought a call options to buy pound with US dollar before this collapse, you have no reason to exercise these options and you're going to just lose the option value. Let's say you observe negative risk reversal today. Negative risk reversal means out of the money put option price is higher than out of the money call option price. So investor put more emphasis, more probability on the value of the out of the money put option, which means probability of collapsing pound. So if you observe negative risk reversal before the pound collapse, it tells us that market participants put higher probability on the big negative movement of the pound in the future. In this sense, risk reversal can be used as the indicator of pound crash risk. For example, how can you use this one in real practice? Let's say you implement dollar carry trade strategy. you're gonna lose if pound depreciate. And you can use risk reversal as an indicator when you need to stop your carry trade strategies. You can get the implied probability of pound crash in the future based on this option price.